Nearly 2,000 years ago, a Roman emperor sat in his tent, the empire crumbling around him, and wrote a private journal. He never meant for anyone to read it. But inside those pages is the most profitable investing advice you'll ever get. And almost nobody follows it. His name was Marcus Aurelius. And alongside two other Stoic philosophers, Seneca and Epictetus, he figured out something modern investors still can't grasp. That the real enemy isn't the market. It isn't inflation. It isn't even a bad economy. The real enemy is you. Today I'll show you 3 Stoic principles that separate the patient wealth builders from the panicked sellers. And the third one is the one Warren Buffett lives by, even if he's never said it out loud. Epictetus was born a slave around the year 50 AD. He had nothing. No wealth, no freedom, no guarantees. And yet, he built a philosophy that shaped emperors. His core insight was simple. Some things are up to us. Most things are not. Think about what most investors obsess over. The federal. The next recession. Tomorrow's price. But none of that is actually in your hands. What is in your hands? How much you save. How long you hold. What you choose to own. And how you respond when things get ugly. Here's the kicker. A 20-year study by Dalbar, a firm that tracks investor behavior, found that the average investor earns roughly half the return of the market they're invested in. Not because the market's bad. Because they keep reacting to things they can't control. The market didn't rob them. Their emotions did. And here's what Epictetus would tell you: if a headline can ruin your day, you've given that headline power over your portfolio. But if you only focus on what you control, you become almost impossible to shake. Which leads to the second principle. And it's a strange one. The Stoics had a practice called Premeditation of Adversity. Translated, it means the premeditation of evils. Every morning, they'd sit down and imagine the worst. A loved one gone. Their home destroyed. Everything they owned taken away. Sounds grim. But here's the point. By picturing the disaster, they robbed it of its shock. When hardship did arrive, and it always did, they were prepared. Calm. Ready. Now apply that to investing. If you bought a stock at $100, have you actually sat with the idea that it could drop to $50? Not as a nightmare. As a real, plausible Tuesday. Because history says it will happen. In October of 2007, the S&P 500 peaked near 1,565. By March 9, 2009, it bottomed at 676. A 57% collapse. Trillions of dollars vaporized. Most investors didn't just lose money. They panicked at the bottom and sold. Then they watched, stunned, as the market climbed for the next 13 years. But on October 16, 2008, right in the middle of the carnage, Warren Buffett wrote an op-ed for the New York Times. The title? Buy American. I am. He wasn't panicking. He'd already premeditated the worst. He knew crashes happen. He was ready. That's the power of this practice. You don't fear the drop, because you saw it coming before it did. And if you think that's counterintuitive, wait until you hear the third one. Marcus Aurelius had a mental trick he'd use when life overwhelmed him. He'd imagine rising up, high above the earth. Looking down at the cities. The wars. The people arguing in the streets. From up there, everything felt small. Manageable. Temporary. The Stoics called this the view from above. And it's the most powerful tool an investor has. Here's why. When the market drops 3% in a day, it feels catastrophic. Red numbers everywhere. Your phone lighting up. Your stomach in knots. But step back. Zoom out. Really zoom out. Over the long arc. The market goes up. Not in a straight line. Never in a straight line. But the direction is relentless. From 1980 to today, Despite every crash, every panic, every "this time it's different" moment, the S&P 500 has compounded at roughly 10% a year. $10,000 invested in 1980, with dividends reinvested, is worth well over $1 million today. But here's the catch. You only get that return if you stay in your seat. If you zoom in on every daily candle, you'll panic. If you zoom out to the decade, you'll be calm. Same market. Different perspective. Completely different outcome. Charlie Munger, Buffett's partner for over 50 years, was openly obsessed with Epictetus. He'd quote him at Berkshire meetings. Because he understood something most investors refuse to accept. Volatility isn't risk. Permanent loss of capital is risk. Price fluctuations are just the weather. So here's the principle I want you to remember. The market will test you. It always has. It always will. But your returns won't be decided by how clever you are. They'll be decided by how calm you are. Control what you can. Prepare for what you can't. And when the noise gets loud, rise above it. Seneca, who by the way, was one of the wealthiest men in Rome, worth an estimated $300 million in today's money, said it best. It is not the man who has too little, but the man who craves more, that is poor. The Stoics weren't against wealth. They were against being controlled by it. And that is the mindset that compounds a fortune. This is educational content, not financial advice. Do your own research and always invest within your own circle of competence. Here's my question for you. What's the worst moment you ever had as an investor, the one where you almost sold everything? Tell me in the comments. I read them. And if this reframed how you think about market volatility, hit subscribe. Tomorrow, we're digging into something I think every investor gets wrong about diversification. It's going to surprise you.